ये रुद्रेश जी,
Hello,
हाँ,
sir. Sir, just one minute, sir. Just 1 minute, sir.
ओके.
YouTube में डाल देगा. We will be starting in 5 minutes.
Yeah.
लिख दे.
Yeah, sir. Hello.
Yeah.
Yeah, sir. We can start.
Should we start now? कौशिक start करें अपने? Hi. Good afternoon, everyone present here today. Our meeting today is to discuss the Nifty Next 50 derivative products. And to speak to us, we have with us today from the NSC team, Mr. Rudresh Kunde, Product Head, and Mr. Vithal Moore, Head Product Strategy and Services and Mutual Fund Distribution. As we all know, NSE is the world's biggest derivative exchange, and options and futures have become a very popular product with all investors. Following the success of weekly options in Nifty, Bank Nifty, Fin Nifty, and Midcap Nifty, NSE has now launched Nifty Next 50 options and futures. Our objective in today's webinar will be to understand this product better and to get into its details. Without taking much time, I would like to hand over the mic to our NSC team so that we can take a deep dive into Nifty Next 50. Please, to Mr. Rudresh, sir.
Yeah. Thank you, sir. So I'll be just sharing one presentation.
Please.
Sir, my slide is visible to you?
Yes, visible.
Yeah. Sir, I'll just switch off the camera because of bandwidth.
Okay.
Yeah. Yeah. So Nifty Next 50, we had launched it last month, 24 to be precise. It's not a very new index. It's there with NSE for a long time. Actually, it is available with NSE since 97. So earlier it was called the Nifty Junior Index or the CNX Junior Index. So it's there for a long time. The index values, etc., are available on Bloomberg, Refinitiv, etc. So the historical data, everything is available to you. Okay. So just to begin with, so I will just give you some introduction to the index. How it is constructed, how it behaves, etc., and what is the index methodology, etc. So just to give you a fair idea, so Next 50 index is a broad-based index. It is a basically represents the large cap index portfolio. Okay, so how it is constructed? So basically, first we categorize the Nifty 500 index based on the market cap. Okay, from there the Nifty 100 stocks are chosen. So 100 stocks are basically all the large cap stocks, basically selected based on full market cap. Once these 100 stocks are selected, within this the first 50 stocks are selected based on a specific criteria which forms the portfolio for Nifty 50. So what is the criteria is basically say impact cost, then the free float, how many days the scrip has traded, whether FNO is available or not. So there are many criteria based on which the Nifty 50 portfolio is first determined. Once this portfolio is determined, the balance 50 companies, they go to form the Nifty next 50 index. So as you can see in our slide here, so with the introduction of derivatives on Nifty next 50, we have three indices, three broad-based indices, which is first is the Nifty 50 index, which is the liquid and the large cap index. The second is again a large cap index, but it's the next 50 stocks. And the third is the Nifty mid cap select. So with this, we have like roughly covered the top 125 stocks in the market. And all these three indices at any given point of time, they are distinct. That means the constituents of all the three indices, they don't overlap. They are completely distinct. Okay. Uh, Another thing point to note here is the full market cap of this index constituents of the Nifty next 50 index constituent. They account roughly for 70 trillion of full market cap, which is like roughly around 18% of the total market cap. So it is not a very small index. Like people who are trading the mid cap, they are familiar. The mid size of mid cap is small, right? Because the market cap etc. is small. When you compare it with Nifty 50 standalone, it may be a big number, but if you compare it with Nifty 50, it is still smaller, as is with the characteristics of mid cap stocks. Okay, so similarly, Nifty next 50, the size is 70 trillion. If you compare it with Nifty, it is definitely smaller, but standalone 70 trillion itself is a very big number, and it is a 18% of the total market cap listed on NSE. Now, if you go with the index market cap, means of the constituents, and because of capping etc., whatever the market cap is resulted in the index. Now that value comes to roughly around 22.5 trillion, which is like around 32% of the full market cap. Now what this number also indicates is basically the free float that is available. Okay, so it is roughly the 32%. So out of 70 trillion, 32% is in the index. Okay, so also as I said earlier, the index has a long history. So over the years, basically, the index methodology has undergone various revisions. So index weighing was earlier based on full float, that is full market cap, and later on in 2009, in around May 2009, it was transitioned to free float weighing method. So if you remember in a decade back or so, that time all the indices were based on the full float, full market cap. But in 2009, they were shifted to free float. Okay. Again, the index went some more revision. So in 2021, weight capping was introduced on this particular index. And in 2023, this weight capping thresholds were changed. So currently, the weight capping stands at all the FNO stocks. The aggregate weight of these FNO stocks is kept at 10%, and individually the stocks which are not available in FNO, they are kept at 4.5%. Okay, so technically what this means is, so all the stocks which are available in FNO, almost 39 stocks, they will account always like around 90% or more of the index. Okay, the balance stocks which are not available in FNO, their weights will be kept at 10%. And this weight capping, it is rebalanced every quarterly, whereas the portfolio is rebalanced half yearly. Okay, I will show you an example of this quarterly rebalance date as well in my subsequent slides. So here, as you can see, the index is top representation from basically financial services, almost close to weight of 24%. Now here, financial services stocks like PFC, REC, Bank of Baroda, they are the top stocks in this particular sector. The next two sectors are the capital goods and the consumer services sector. Now, capital goods again close to like 12.5%, and consumer services another 12%. So together they roughly weigh for around 25%, 24-25%. Now these two sectors are unique. Why unique? Because they have only representation in this particular index. If you go and see the Nifty 50 index, which is the larger index, there you don't have any representation from capital goods and consumer services sectoral representation. Okay, there definitely financial services is common to both the indices, but capital goods and consumer services, these are the two sectors which are available only in next 50 index as of now. So as of now, the portfolio stands today. These two sectors are unique to this particular index. Similarly, what we observe is you on the left hand side, if you see the entire sector representation, you might have noticed that IT sector is missing. So IT sector is what is not there in Nifty Next 50 and it is there in Nifty 50. So Nifty 50, the second largest sector is represented by IT, whereas IT sector is not available in Nifty Next 50. Now, these are some of the things which make the index unique, right? So you are not trading another Nifty 50. It is a unique index. Okay, so Nifty 50, it has a sector representation of a different kind. Nifty Next 50, it has a sector representation of different kind. Again, one more thing here you can note is the top 10 stocks, right? The top 10 stocks here weight about 35%. Whereas if you see the top 10 stocks in Nifty 50, they would be like roughly around almost 55-56%. Okay, even if you see mid cap select index, there also the top 10 stocks, they will account for almost 50%. So here if you see, because of the weight capping, because of the methodology, the distribution is quite, I mean, it's a diversified, right? The top stock, the trend also is like around 5%, which is not the case in case of Nifty 50, right? So here it is more diversified, more balanced. Okay, before we just move forward, so I would like to mention here, so the index methodology here is basically a periodic kept free float methodology. As I said earlier also, it is kept method. So based on free float, but the free float is kept. Okay, so let me come to the capping part. So here, as I was mentioning, the weights, they will keep on changing marginally because of the prices. Okay, and at the end of the quarter, whether if it is gone ahead of 10%, it will be, the capping will be again redone, rebalanced. Okay, so here if you see on the screen, these are some of the stocks which are not available in FNO, and if you see end of every quarter, the total weight of these stocks is below 10%. Okay, now if you see in end of March 2024, this these stocks, they account for 9.95%. Whether when it is moved to April, it has slightly reduced. Now here the case may be because maybe the prices have come down, etc. So these weights keep on changing. But again, when you go to say June 24, okay, that time suppose if the aggregate weight of these stocks moves say above 10%, say it went to 11%, again they will be adjusted and brought back to 10%. Okay, so that is what I was meaning by quarterly rebalancing for weights. Now, when else these weights can change? So during the portfolio review, so semi-annual portfolio review, so which happens half yearly. So that time, if any stock, any of the stocks say goes out, or a new stock comes in, which is either FNO or non-FNO, based on that, these weights will change. Yeah. So now just moving ahead from the index. Now this is just giving you an overview about the liquidity profile. Now the 50 stocks which are there in the index, they are quite liquid. Okay. If you see their aggregate daily average turnover in cash market itself. Now in April only, just the last month, so it has accounted almost for 15,600 crores of daily average turnover. Okay, which is roughly around 15% of the total market. Okay, so that indicates that the underlying stock itself are very liquid in the cash market. Again, if you come in the derivative side, so 39 stocks which are available in derivatives. Now they also account for a good volume, good daily average of almost 33,700 crores in April in stock futures. Now again, this number corresponds to almost 21% of the total stock futures market. So you can see these constituents, they are very liquid in the stock futures as well. That means people track these particular stocks, track this particular index for their derivative needs. Again, in stock options, you see in terms of premium turnover, the number is almost 18,000, sorry, 1850 crores. The daily average is 1850 crores in April, which again is quite high. It's 24% of the entire stock options premium turnover in April. And if you see in FNO, at least if you see like last 6 months, the trend has been increasing. So this shows the interest of the market participants in these constituent stocks. Okay, the underlying stock, underlying cash market as well as underlying derivative market. So both places these are liquid. Uh, Before we go ahead, so one more thing here I would like to add. So the stocks which are not in FNO, so those stocks also, if you see their daily average turnover or their delivery turnover, or they are say median quarter sigma, or their impact cost. So all these factors for those stocks are also very good. Just that they have not got permission to launch in derivatives. Otherwise, most of the stocks they are also eligible individually for being available in derivatives. So as and when tomorrow SEBI gives permission, they would be included in derivatives. So even if you see their liquidity profile, the data is available on a NSE website. So all this average impact cost for last 6 months, average daily delivery turnover in last 6 months, median quarter sigma order size. So those numbers are also quite good for these stocks. Now coming to the returns part. So returns wise also, you might have read in the papers also some time back that this index is among one of the top performing index. So you might have seen previously also that like last 2 3 months what has happened is like the SME indices they have performed well, the small caps have performed well, mid cap have also performed well. So similarly Nifty next 50 it has also performed extremely well. So last 1 year the returns, these are basically total returns, so the dividend etc is included here. So here if you see it's almost gone up by 65%. Even if you see the CAGR, the cumulative annual growth, so that has been also quite high. In fact it will be like comparable to mid cap. So this is almost like 24% CAGR returns in last 3 years and almost 20% returns in 5 years. If you see also the graph, if I see, so we have rebased it around 2021. So in the last 3 years if you see, it has been one of the better performing indices, right? If you compare to Nifty 100 or Nifty 50 or even the Nifty 500, which is the larger index, right? So the returns have been extremely good. In terms of volatility, etc., here if you see, the Nifty Next 50 uh, is quite volatile if you compare it to Nifty. So the last 1 year volatility has been 13.5%. If you compare it for last 3 years, it is 16.5%, 16.3%. So if you compare it with Nifty 50, which represents the large cap, the volatility is slightly higher side, right? I mean, the volatility of Nifty Next 50 is more like comparable to the mid cap stocks. Okay. So just for information, I've put the volatilities of Bank Nifty and Fin Nifty as well. So for a 3 year period, you can see it is like comparable with Fin Nifty also. In terms of correlation, so here you can see the index is having a comparatively a lower correlation with Nifty, but higher correlation with the mid cap stocks. Now this may be because of the nature of the index. So these are the next 50 stocks, not the top 50 stocks, and hence it has more correlation, more affinity towards the mid cap stock. So someone who is having a mid cap portfolio, now this is a lot of ETFs, lot of mutual funds, they are into mid cap portfolios, right? Even the FPIs, etc., they are investing beyond the top 50, top 100 stocks. If you see, even our overall cash market volumes now, more than like 50% volumes now come from the beyond top 100 stocks. Now, all these are basically the beyond the Nifty stocks, right? The next 50 stocks or the mid cap stocks. Now, for all these portfolios, Nifty next 50 also would be suitable from a risk management perspective. These are some of the key contract specifications. So there is a QR code on the right hand side. So in case anyone wants to see the detailed contract specs, you can just scan that QR code and it will take you to an AC circular. So the circular was issued just before the launch. So when we launch, we begin with the monthly futures and the monthly option contract. The expiry day here is the Friday, so it will be the last Friday of the month. So in terms of value, the contract value here, so it is around 6,56,000, considering the index as 65,600. So the lot size basically is 10 here. So if you multiply it with the index value, which is roughly around 65,600, the value will be somewhere around 6.5 lakhs. So if you see, the value is not very low towards the 5 lakh side, but not very high towards the 10 lakh size as well. Again, like all other index derivatives, here we have the European call and the put options. Okay. Now, strike scheme is something we have introduced here, a staggered strike scheme from day one itself. Okay, so other indices also except for Nifty 50, I think we have all moved towards the staggered strike interval, and I'll just show you what is the benefit of it in the subsequent slide. So why we are doing this? Okay. So I've just put a pictorial example here. So assume that the ATM or the index is somewhere around 62,000. So the 62,000 strike will be ATM. Now we have two strike scheme here. One is the narrow and one is the wider one. So the narrow strike scheme is basically the strike interval of 100 with 40 strikes. So what this means is from the ATM you will have 40 strikes with an interval of 100. Okay. Now if you see, it will continue start from 62,100, 200 and so on till the 40th strike. So 40th strike comes somewhere around 66,000. Okay, so this will give you a coverage of almost like 6% from the index. Okay, now how the 500 strike interval or the wider range will work here is the strike scheme will start from 62,000 only. So the 62,500 strike interval will be an overlap. Okay, so this is not an additional strike, it is just an overlap. So basically the new strikes which you will get because of the wide range strike interval will start from 66,500. That's where the benefit of the wider range strike interval kicks in. Okay, so from, if you see from the ninth wide range strike, which is 66,500, the next intervals are 500 multiples. Okay, so it will go to almost like 72,000, which is the 20th strike. So here if you see, because of this the range on the either side of ATM has been increased. Again at the same time what has happened is the number of strikes has been curtailed. Okay, so this wider range strike interval, it is giving you a range. So in case someone is anticipating that there will be a wider move in the index, the range is available. At the same time there is less fragmentation. Suppose if we had to continue the 100 strike interval till say up till 60 or 80, you would have received the range, right? But at the same time what would have happened, the number of strikes would have increased from 40 to 80. So managing that from a trader's perspective etc would be difficult. Now what has happened is because of the lower number of strikes as well as the range availability, the order aggregation is happening. So if you see right now, since this is a monthly contract, at the start of the month most of the strikes which were getting traded were multiples of 500 and not of 100. So as we are progressing towards the expiry, there is a chance that the volumes will get aggregated in multiples of 100. Okay, this is similar to like what you might have experienced in bank nifty. So if you see in bank nifty say monthly strikes or the second month strikes, so there most of the strikes which see liquidity or which see open interest build up, they are either in multiple of 500 or 1000, right? So similar is the case here. So this is basically this Nifty Next 50 index is a very high value index. As you can see, it's almost like 65,000 now. And till now, all the other indices on which we have derivatives, their values were less, except the Bank Nifty, which is like 45,000, 50,000, that range. But otherwise, all the other indices are like 20,000, 10,000, etc. But this index is something which is like 65,000, right? So here the 500 strike interval is also quite important. In fact, before going to the volume, you might have also observed that if you see the option chain even today, so the volumes or the OI built up is generally in 65,000, 70,000, and means multiple of 500 strike interval contracts. This is just a volume graph. So it is just picking up. This is turnover and contracts traded. This is basically total derivatives volume. Now here right now, since it's just a start and we have not even completed the first month expiry, so right now not 100% of the members have participated, but just to give you a fair idea, the number is upwards of almost 400. So most of the members, they have like almost 60-70% of the members they have tested. On an average we are seeing almost 200 members they are participating. And I believe so from this week or the next week towards the expiry, the volumes will again pick up, and probably after the first month expiry, the some of the institutional players, they will start moving because they generally wait for the first expiry to get completed before they start their trading here in this particular contract. So next week is where we will see the action in this contract very much. In fact, from maybe tomorrow or day after tomorrow, it will start, and the next week being expiry, so we expect the volumes there to go up. Again, post that, the June expiry when it comes, I think most of the players would have experienced the expiry, the setup, etc. People's mobile application, etc. would be in place. So I think all the any teething issues, etc. If it is there, it will be resolved by then. But already, just to give you information, so even the retail broking firms, some of the top broking firms, in their mobile application, etc. Also, this contract has already started, so it's available to all the masses. So these are some of the just key points. So launch date, we had launched it in April 24. That time we had not launched the April contract. So basically the first expiry is May 31st. So that's why I was mentioning that some of the players like institutional FPIs, etc. Only few people they start in the beginning of the week. Most of them they would wait for the first expiry. The institutional people. The other people they have already started. So as I mentioned, more than 400 members they have already started trading in this particular contract. Right now there is a transaction charges waiver, so with like all other products where in the initial days there's a waiver, so even for this product there's a waiver. So up till October 2024 there is a transaction fee waiver. Reserve strikes, as is applicable for other indices also, so reserve strikes are available here. So basically what it does is, suppose if there is a large intraday movement, the new strikes that will get enabled during intraday in the direction where there is a movement. Earlier also I was mentioning, so this is a quite an old index, so it's available for a quite long time, and the values, index values, etc. it's available on Bloomberg, Refinitiv, etc. So you can go and see for any of your charting or any historical data. If you want, you can go and check here. Again, suppose someone needs any kind of historical data for last 3-4 months or 5 months, I think you can get in touch with our BD team, our relationship managers, and they can arrange you for a historical data for a certain period. Yeah. So if you have any questions, we can take up now. Okay. So till the time maybe questions.
Rajesh,
Yeah.
like in this Nifty next 50, the top 10 says weight is 35% approx.
Right. Right.
What is the weight of 10 top 10 says in Nifty?
Nifty, sir, it is almost 55%.
Oh,
55%. So what is happening is here, because of the way the index methodology works, because of the capping, and mostly when you go down the stream, so like next 50 or mid cap, the stock size is like similar, unlike Nifty. So Nifty, what we see is the top 5 stocks, they are really heavyweight. They are like, I mean, the top stock in Nifty and the bottom stock of Nifty, the values differ quite a lot. So here what has happened, the values are more or less similar, I would say,
right.
the free floats. So because of that, it has become quite diversified. So one stock movement may not abruptly change the index.
I mean,
So that,
Nifty next 50 will be less volatile in that case.
no, it is volatile because the stocks are itself volatile. So if, yeah, I was showing the volatility profile, so there if you see, the volatility is almost 13-14%, as compared to Nifty these days is 10%.
Right.
So the stocks which are there, the portfolio which is there, like you have the DMart, you have some of the Adani stocks, etc. So they are, by nature, they are
They
quite
will be
volatile.
volatile. Do the
Yeah,
stock.
yeah, yeah.
Thank you.
So some of the other questions which we generally encounter these days in other NME meetings also. So people generally ask that OTR ratio or the persistent noise creator, those things are applicable. So those things are applicable here as well, just to inform. So there is no exemption for this index because it's a new index. Again, the self trade prevention, etc. All those things which are applicable for Nifty, etc. That is applicable here as well.
So Rudresh, so I had like a small question. There is a significant contribution of the financial services sector,
Yeah.
almost around 29%, if I remember correct from the slide. So
Yeah.
that's another index with a heavy financial services
Right.
contribution.
Agreed. So if you see financial services, any index, if you take Nifty 500, Nifty 100, Nifty 200, financial services is there. That's something which we cannot remove. I mean, that's if you see the Nifty 500, it's like almost 35% is financial services. And again, if you see from an investment perspective, like FPIs, etc., if you see their AUM, so they're also like 35% or more than that is financial services. So any broad-based index, I don't think we'll be able to remove the financial services outside unless we have tomorrow some kind of a index which is like say Nifty 100 X financial services. But that's highly unlikely because financial services is where the action is these days. So yeah,
Understood.
yeah.
Fair enough.
But
Just to
only
add
thing
to
is, yeah. Go on, sir.
Yeah. Just to add to what Rudresh mentioned, so typically these indices represent the uh, portfolio underlying portfolio structure. So accordingly, even for the 500 and for the entire market also, the kind of weightage which financial services sector has, that would be reflected in any of those market representative index. Now, in this index, the only maybe a differentiating factor would be it gives exposure to the large capitalization segment. At the time, these are the large capitalized stocks beyond top 50. So it has some growth potential also, which typically is provided by the mid capitalization segment. So it is very nicely placed between these are the companies which have graduated from the mid capitalization segment. They have come to large, still has a potential further to challenge any of the Nifty 50 companies. So that's why you get a good mix of growth and the stability of that company. So these are better, more stabilized, large capitalized companies, but still has a good growth potential. That's the kind of exposure which investors will be able to get through this index.
Yeah. Any other questions? Yeah. So one more thing which I would like to mention here is May month being the result season. So a lot of the constituent stocks, their results are being announced right now. And if you see the dividend yield of this index, so right now it is little bit lower than the Nifty 50 index. But historically, last 2 years, if you have seen the dividend yield in May, in June, or the subsequent months, it gradually overtakes the Nifty 50. So the dividend yield right now for this index is slightly on the higher side. So in fact, end of March it was somewhere around 1.3, whereas Nifty I think it was around 1.1 or 1.2. Any other questions?
Since there is no questions, so we have very good discussion. I request Kaushik to please give a vote of thanks.
Thank you, Ravinji. Uh, as we wrap up this session, I'm pleased to extend vote of thanks on behalf of ANMI. First of all, I would like to thank NSE for not only hosting this webinar, but coming up with a new product, which is an opportunity for all of us. This product in itself, I mean, it adds diversity to all the existing indexes that we already have, as rightly pointed out by Vittal sir, that it sits very tightly between Nifty and the Nifty mid cap. Also, I mean, given that it has constituents which significantly contribute to stock futures and stock options turnover, it promises to be a robust product. So I think market participants will be very happy to add this kind of a diversity to their portfolio. Thank you, Mr. Rudresh Kundu, for giving us the insights into Nifty Next 50 and all its various characteristics. Finally, thank you to the participants for joining and making this session a success. So a big thank you to everyone. And on this note, I would like to end this session and wish everyone a pleasant day.
Thank you.
From NSE side also, we would like to really thank ANMI team to for providing us opportunity to connect with ANMI members for highlighting the features of the Nifty Next 50 derivatives. And special thanks to Chairman Ji, Ravindra Ji, and Executive Member Kaushik Ji for participating in this session and guiding participants through the session. Thanks a lot.
Thank you.
Thank you, sir.
Thank you.